So we all know that interest rates have been crazy over the last year or so, and we may see them come down, we may not. The perfect solution to get around this is creative financing. If you are simply stuck going to a traditional mortgage broker, putting 25% down on every single one of your rental properties, it's gonna take you forever to build your portfolio unless you just happen to be making $300,000 or $400,000 at some W-2 job so that you have enough saved up for down payments every single year. You should be looking at creative financing that helps you get around credit checks and income verification and having to look at your portfolio. You should really be exploring different options that will take less cash out of your pocket and allow you to use the cash that you do have on hand for other future investments. So exploring creative financing will help you grow your portfolio quickly. Today, we're gonna break it all down for you. Let's dive in. Hey guys, I'm Andrew Lewis, real estate investor and entrepreneur with over 10 years experience building and growing a real estate team and investing in real estate. Before we get into today's content, make sure you take a minute to hit that like button, leave a comment below, and don't forget to subscribe so you don't miss out on future videos. I'm here to help you break out of the 9-to-5, gain financial freedom, and grow wealth through real estate. So interest rates are high and you're tired of putting down 25% on every single one of your investments. So now it's time to take a look at creative financing to start to grow your portfolio. There are gurus out there that will tell you that you can do everything with no money out of your pocket and no credit checks and all of that. And you know what? In some scenarios, that can happen. I field phone calls all the time from people that have listened to those gurus and say, my credit is trash, I have no money in my bank account, and I want to own 10 rental properties by the end of the year. How can you help me? The reality is you still need to be set up well to take advantage of some of these creative finance opportunities. And hey, I'm not bashing. If that is where you are currently with your financial scenario, you just need to put in the work. You can find those deals, you can make them happen, but don't just call up a real estate agent and say, help me find this, here's my scenario. You've got to go find those deals. You need to put in the work, but then we can apply some creative financing tactics to make sure that we can acquire some properties for you and help you meet your financial goals. And today, I'm gonna break down 4 ways you can use creative financing to secure future investment properties. Number 1 is to explore private lending. You don't always need to go to a local mortgage broker and have them run scenarios with all of the big banks and run that past them and have to go through all of their qualifications. Private lenders can actually take a look at different things. If they are a private lender, they're often using their own funds, and sometimes even direct lenders will use their own funds and allow you to go outside of the traditional parameters as far as credit and income and how many properties you own and all of those other aspects as far as your qualifying ratios that go into getting a mortgage. So private money can be a method that you can use to give them a look at your overall portfolio and say, hey, here's my overall portfolio making X amount of dollars a month, and here's all the debt that goes along with that, but here's the property that I found, and here's the projections as far as the rent. And sometimes they're able to look at that actual property by itself and have it make sense. I actually even just listened to a podcast with somebody on it where she had no credit at all. She came from a different country. She did have some income, but she found a great deal on her own and took it to a private lender, and they financed her with no credit at all. It's essentially like an 18-year-old walking into something and getting a loan magically because they presented a good deal. She treated it like a business. She said, here's what I'm going to make, here's what my expenses will be, here's what you are going to make bank off of this deal. Can we make it happen? And you know what? She actually faced 100 no's before she got a yes, but guess what? She bought a home with no credit using a private lender. So you're gonna have to get creative there. You're gonna have to do some sales pitching as far as trying to make a private lender jump on something if you're working with no income or bad credit or any of those scenarios, but they are willing to take a look at some of those properties, and that can help you if you don't have your 25% down, if you don't have the good credit. So take a look at private lending. Number 2 is assuming a loan. So this is a scenario that we've seen played out a lot over the last year or so as interest rates have spiked through the roof. A lot of sellers have offered the option to assume the loan that they currently have with a low interest rate. That's an awesome option that allows you to get around the high interest rates. It's not gonna help you get around the qualifications and income and credit score and all of that, because you will actually, in this scenario, have to qualify with the current lender to assume that loan. Because the reality is, the whole reason they make this happen is the bank doesn't want that loan to be paid off because they want to continue to make the interest off of that product. The longer they keep that loan product, the better it is for the bank. So if you call in and say, I need to assume this loan, they're gonna wanna keep that going, but you still have to fit the income qualifications, the qualifying scenarios for your debt to income. You still need a great credit score, and you're gonna have to qualify for that. Now, the one catch here is that most people don't think about when it comes to assuming another person's loan is you're going to have to pay the difference in cash of the asking price for the home and their current loan balance. This could work out great if they just bought the home last year and they don't have a ton of equity. Then that is a great scenario that you can use because you're not gonna have to come in with a ton of cash, and you can just assume that loan and take over the payments and have that low interest rate. But if this is somebody that's had a property for 10 years, or maybe they've even owned it for just a short period of time, but they put a huge chunk of money as a down payment, it's gonna be difficult for you because you can assume that loan, maybe $200,000, but if the house is worth $300,000, you're gonna have to come up with another $100,000 cash to make up that difference so the seller can walk away from that. So this theoretically is a good one, but you're still gonna have to qualify traditionally and have the money ready to make it happen. So the one advantage here is that you can get around the high interest rates. And for investment properties, this actually can work out really well because doing something like this can increase the cash flow for you significantly because you're not paying the high interest. Next up, we have subject to. This is one of my favorites. It takes a bit to wrap your head around it, and it can scare some buyers, it can scare some sellers. It's not for everybody, but if you can acquire a property subject to, you can get an absolute steal of a deal. What this means is basically you are taking over the payments for a property subject to that loan. So you're going to acquire the property, take over the deed, and the deed will be in your name, and all you're doing is taking on the existing loan. And you're not putting that loan in your name. So there's actually no qualification that has to happen here. You are just guaranteeing the seller that you will make the payments on that loan going forward. So this one is super creative. So imagine the scenario this way. You own a house and it's worth $600,000 and you've got a $500,000 loan on that property, and someone comes to you and says, I want to take over your payments. Well, the seller here is going to think, hey, I've got $100,000 equity. I'm not giving that up. Here's where subject to can come in. You can take over the property subject to that current loan. You basically are going to make the payments on that $500,000 loan for that seller. And then you can either make payments to them on the equity that they have. So maybe you throw in an extra few $1,000s a month to pay off that equity, or you just take that down payment that you would have had for a traditional purchase and that's what you apply towards that. This is great because it actually alleviates any need for you to qualify at all. You don't need to run your credit, you don't need to prove your job, you don't need to prove your income, nobody's looking at tax returns or bank statements or anything like that. This is an amazing solution here. So it may cost you some cash because you're gonna need to make up the difference between a property's actual value and the loan value. So similar to assuming a loan, however, you're not actually assuming the loan. The seller is the one that has the risk with the loan there. Usually in this case, you would make payments through a servicer. So you would pay the servicer would pay the mortgage so that you're not actually having to pay that directly and it's not putting all of that reliance on you. And so the seller has a little bit more peace of mind. But this allows you to just take that property over and you can take on multiple properties this way. So if you're looking for a scenario where you pick up a property with no income, no credit checks, and no down payment needed, then maybe you'd be looking for a property that somebody just bought recently and is having to sell for some reason. Sometimes this could be a notice of default or a short sale or somebody who's being relocated and needs to sell something quickly. This is a great option if they don't have a ton of equity because you can just come in and take over those payments if they were going to zero out anyways. And it's a great solution. You don't have to take on all of that debt. The seller is the one who carries on that debt for the next 30 years or the life of the loan, and you get to move into a property or move tenants directly into that property. Last but not least is seller finance, sometimes referred to as owner carry. This is an option that basically a seller who owns a property outright, or maybe is willing to pay off their loan in order to make this happen, is willing to carry the loan for you. In this case, they're basically just going to name the terms of the loan. And so maybe they own a property outright, it's worth $300,000. You're gonna come in and buy it. You don't have to qualify with the traditional lender if they're willing to carry that note. maybe for them, they don't need the cash in their pocket right away, and earning 7% interest would be an advantage to them because, let's face it, they can't really put their money anywhere else that's gonna earn them 7% without any sort of risk. So they will carry that for you. So that $300,000 note becomes due and payable to them. You're gonna make monthly payments on whatever interest scale that they determine. And basically you've just gotten around having to qualify with your debt and income and all of those pieces. The seller may require you to give some of that information to them. They're not a full lender, so odds are they may just look at a few documents for you and go with it. So maybe this is a way around credit, because they're not gonna run your credit. They may just look at your financial scenario and help you make this happen. So a seller carry is also an awesome option. However, they do need to own that property out free and clear so that they can do the loan for you, because they just can't stack that on top of a loan that they already have. So those are 4 ways that you can use creative financing, which will get you around high interest rates, high down payment amounts, needing to run credit, needing to verify income, all of those pieces. Not all of those pieces all fall into one category. Again, if you just don't have any money and no credit and no job and no verification of any kind, it's going to be extremely, extremely rare for you to find a deal where you can make all of that happen. But if you just happen to be making a steady income and have bad credit for one reason or another, you can look at one of these options to get into a home without a lender traditionally running your credit. Same for the reverse side. If you've got great credit, but you just don't have some of the income, any of those pieces, you can get into some of these creative finance options to get into a property with no money down or no credit check or verification, any of those pieces. So these are great solutions. They do take a little bit of brain power. So this is where you're going to have to put in some sweat equity, because I promise you, if you just come to a seller with a subject to scenario, they're gonna run for the hills because they don't understand it. There's a ton of nuance that goes into that, and the way that you present it to them is going to determine whether you've created a successful deal or not. Same thing with an owner carry. Any of those pieces, you're going to have to present it well. So you're gonna have to put in some work. You're gonna have to find deals that fit into that bucket. You're not gonna go buy some home that the seller, has 50% equity in the home, and they're looking to cash out and move to a different state and they need all of that cash. In that case, most of these scenarios aren't going to work for you unless you assume a loan. So this isn't gonna work for all houses. You're gonna have to hone in on which product you need to use for your specific scenario, and then do some hunting to find sellers and find deals that will fit into that scenario. And a lot of times that is speaking directly with a seller, with an owner, or maybe their agent, and trying to understand their pain points. What are they looking for? Oh, they don't have a ton of equity? Here's an option that I have. Oh, they're desperate and need to get some cash? Here's an option that I have. Oh, they have a great interest rate and I can qualify for that? Here's an option that I have, and potentially can save you some money on the top of the purchase price. So you're gonna have to put in some work to make these happen. We'll do future videos here that will explain each one of these in more detail and walk through some of the details of actual deals that are in place with some of these, and we'll put those up on the YouTube channel here in the future. I hope you enjoyed today's content. If you did, make sure to take time to hit that like button, leave us a comment below, and don't forget to hit that subscribe button so you don't miss out on future videos. I'm here to help you break out of the 9 to 5, gain financial freedom, and grow wealth through real estate. See you next time.